Well, as the Federal Reserve's second round of quantitative easing comes to an end, my next guest says QE3 may be on the table. Joining me now from Chicago is Bianco Research President Jim Bianco. Also with me, of course, John and Dominic. And Jim, QE3, you think could be on the table? Really?
Yeah, it could definitely be on the table. It's the Fed is looking at being one of the only institutions that can help the economy. And if the economy were to start to weaken, and the soft patch that we've seen may be the start of it, I definitely think QE3 could be a possibility. Now, I would go as far as say it's not now. We haven't had enough weak numbers yet to put it in as a possibility. But unfortunately, we seem to be moving in that direction.
But almost nobody is talking about this.
Oh, I disagree. I think a lot of people are talking about it. I think what's happening is this is very similar to what you saw at the end of QE1. A lot of the Fed watchers are saying this won't happen. They said that after the end of QE1. But market participants are saying this is a possibility. And as we found out by August, the market participants were right. The economy weakened. There was talk of a double dip. And the Fed came in with more assistance for it. And they think the same thing may happen again.
Yeah, I mean, I think the way a lot of people think this is going to work is the Fed goes back to square one or neutral and sees how the economic numbers come in and then decides from there. We said earlier there's a jobs report next week. I mean, the last time the unemployment rate in this country was below 8% was, I think, 2.5 years ago at the very least. And that is not what the Fed or anyone sees as an encouraging sign.
Well, it's not just that, and one of the things that we're talking about also is that we've seen this slow and steady bid or buying of Treasury bonds as things have gotten a little bit weaker. So I guess the question is, you know, and maybe for you, Jim, the question is how much of that bid to Treasury bonds is as a result directly of this idea that the economies around the world are getting worse, and how much of it is anticipation that the Fed could step in as a buyer again at some point?
I think it's a little bit of both, but more so that the economy is weakening. And as you were saying before, I agree. I think of QE3 as like an option. It's not that the Fed's going to announce it on July 1st. They won't. But if the economy sinks enough, then they will exercise that option to use it. And the marketplace is of that opinion as well, too. And that's why you've seen yields fall, and you've seen a lot of people start to wonder whether or not that's going to come, more so in the marketplace than, say, from the Fed watching community.
Then, Jim, what do you think will happen to the markets once the QE2 program ends? What's going to happen?
I think that they're going to probably start to drift as they have been over the last month or so. We've had about a 4% correction, and we'll kind of drift here until we get our bearings as to what comes next. Is this soft patch going to be as temporary as a lot of people think and kind of dissipate by the end of the summer? Then the markets can trade up. If the soft patch worsens, then we'll start to price in the possibility of the Fed coming in with more assistance. And how would the market react to that? I actually think in that case, the inflation plays would probably work more so than they have in the past. That would be more positive for things like gold and basic materials than it was in the past now. But that's only if it happens.
And to that point, you see this trend in the markets. People have sold the stocks that did well, the commodity stocks, and yet whenever there's some headline that says, you know, this firm thinks copper is going to continue to climb, people will get back into those groups very quickly.
Well, it's not just everybody's become so much more tactical. Long gone are the days of the long-term investor out there. Everybody gets a little bit skittish these days when that happens. So you see everybody moving a lot more that way. But
given all of that, though, then Jim, then how do you account for this drifting? Then how do you still say, though, that stocks are going to be an outperforming asset class? Is that what you say?
Well, as far as the drifting goes, you know, why everybody's been so short-term and tactical, let's go back 10 years. The Dow Jones Industrial Average is at the same level, essentially, that it was 10 years ago, and there hasn't been any money being made from a long-term perspective. We've had a couple of booms and busts along the way, and that's why people have tended to be more tactical. As far as the stock market goes, yeah, it'll probably end up the year in the plus column unless the soft patch turns out to be really ugly. But as far as it being a wonderful performer that's going to give you 15, 20% or something along those lines, I don't think that that's in the cards. Again, unless you see the economy really start to take off. But that's not what we have going on right now, and that's why I think we'll continue to drift sideways.
Jim, thank you.